I need some traction. You need some traction.
Excited to bring another great topic to you guys today. Traction, as always, brought to you by Boast.AI, Launch Academy, Growth Blazers, Founders Institute, Salaried Institute, and BCF Ventures. Got a great topic today. We're going to be going over on how to extend your cash runway with R&D tax credits. We got TriNet helping us with this one today, along with Boast.AI. So excited to dive into the details of that. Just on the housekeeping front, we're obviously going to have a recording of this posted and sent around to all the participants. So stay tuned to that if you didn't get a chance to check it out. Also, feel free to ask any questions in the Q&A section in the chat panel, and we'll have a Q&A at the end where we can dive into any of the details anyone might want to ask about this. So yeah, excited to kind of get this going today. We've got some great hosts to help us out here. We've got Ashley Crawford, an R&D tax manager at Boast.AI, Tim Hansen, a director of business development at Boast.AI, and Ed Coady from TriNet, who's also on the director of business development. Thanks everybody for joining us today. Really appreciate it. Awesome, fantastic. I know we wanted to kick this off and really jump into it. I know I had some personal questions just around the PEO and TriNet and how that all works with like growth. I mean, I was a founder myself and I went through it and I never used a PEO when I heard people talking about it. And I've always been curious on the benefits of, so maybe let's, if we could just start from the top and, what is a PEO at its basic level? Ed.
Well, thanks, Russ. I'm excited to share. It's a concept that, surprisingly has been active in the States for maybe 31 or 32 years. It's an IRS construct, but having said that, I think maybe just under 10% of the small and mid-sized businesses in the U.S. are using a PEO. So a PEO is a professional employer organization. So the construct allows co-employment. And under that co-employment, small and mid-sized businesses can use the PEO, and sometimes really it's for many different reasons. They could be aggregating health insurance benefits, which are fairly complex. It could be streamlining, the ability to kind of turnkey as a founder, as a startup, have like an applicant tracking system or performance management system or expense system kind of built into your basic HRIS or human resource system. But all of those can really be turn on or turn off options for each startup as they use them. So having the ability to do that as a startup benefits from it is kind of nice. I think, we've seen historically about 10% roughly year over year of businesses moving towards the PEO. But with the pandemic and some of the compliance challenges that small and mid-sized businesses wanted to offload, it's accelerated dramatically. One of our partners said that in 2020, they had just over 21% of their small and mid-sized businesses move to a PEO. So, that the concept of outsourcing or aggregating, honestly, each business probably makes that choice on their own about what they see value in the PEO, but the adoption of PEO has been accelerating dramatically. I hope that answered your question.
Yeah, no, that definitely does. I guess one of those things is increased flexibility, right? Which is, a major component for a lot of startups being agile and being able to adapt with, the changing circumstances that they're kind of going through when they're trying to figure out product market fit and their go-to-market strategy. So that could be a definitely big benefit on that front.
Yeah, absolutely. If I could I'll piggyback on that. I think two things really when it comes to being agile or nimble. Someone might want to hire. I mean, that's kind of startups do hire from time to time, but that poses some challenges. If that person that candidate that you're after might be in a different state with different kind of rules or compliance issues, that is a challenge as a small business trying to navigate some of those compliance issues on my own, but also, just being nimble and as my business pivots, I might really want to have an expense management system built in without necessarily going out and finding a new vendor and finding out if they integrate with my accounting system. So that the ability to have those features built in really, I think, enables startups to be nimble and agile, addressing the changes for their business and for the market.
Yeah, and great point. And kind of witnessed it ourselves. We've really embraced the remote culture, and I think we've got employees in about 12 different states right now.
Wow.
So, based off of that, you definitely can find some shortcuts to help us with that. So, no, that's fantastic. Just in terms of engaging, what is that earliest stage? Like, when do people start thinking about engaging with the PEO? Is it really early in the cycle, or is it really just depends on the growth profile that they're about to go through?
That's a really good question. I mean, it's kind of, I think it kind of depends on, the startup and the founder. And sometimes you have serial entrepreneurs or serial founders who, have done things a certain way. But I think it's a little harder today than it has been. The demand for talent has I just think it's never been this difficult for companies to find and attract, the talent that they need. So we're seeing much smaller companies come to PEO than ever before. Our average client used to be, gosh, I mean, we have some great marquee names, but they used to probably be 17, 18, 19 employees, and they were really looking at that next round of funding to kind of catapult. But recently, with the challenges that I mentioned, clients 5, 6, 7 employees have been coming to us frequently because having an attractive benefits package that would make that person want to come aboard, it's just it's really indicative of that. They've called it a war for talent for a long time, but I think that's kind of cliche. So it's truly difficult to bring someone into your organization if you don't have fantastic and competitive benefits. One other thing along those lines, Russ, this time of year, a lot of companies look to us to do some benchmarking. And that benchmarking could be about benefits, like I mentioned, but frequently the questions that we're getting are about compensation. Whether it's a life science company or a technology company, a lot of founders want to know how competitive their total compensation package is with their peers. Because some of those are kind of closely held secrets almost. So
Yeah.
getting a chance to kind of benchmark, maybe in my industry or in my geography, lets me as a founder know how competitive my total offering is. So this time of year, as companies are thinking about 2022, is a really good time to see how we're positioned as we go into next year.
Yeah, that's a great point. And just given the current environment, which is slightly inflationary, which might not be transitory, might be a little bit longer longer lasting than we're anticipating.
Mm-hmm.
People really need to pay attention to that total compensation to make sure they are competitive in the market. So that's a great point on the benchmarking front, and appreciate that. Yeah, fantastic. So with that, we're going to tie back into the PEO side, but we're going to just switch gears a little bit and jump into R&D tax credits and how that works with extending your runway, and again, helping earlier stage companies, be successful, find cash, and help them grow faster. And that fits along the lines of being agile with the PEO. So with that, I'm going to turn it over to Ashley and Tim on the R&D tax credits.
Awesome. Thanks, Russ. And thanks, Ed. I appreciate, having this opportunity to work with TriNet to talk about R&D tax credit. But I think it really does tie in well with really the PEO model and what TriNet does in terms of, working as smart as possible and getting every benefit you can to help your business grow. And so Ashley and I will, go through the process here in terms of how the R&D tax credit works. We'll focus mostly on the payroll tax credit. And, Ashley Crawford's an expert on the tax side, and she'll talk to you about the 4-part test and how those kind of become cost categories that end up becoming a benefit for your business. And then we'll go through an example too at the end, have it on a payroll tax credit. But hopefully just to give everyone kind of a background understanding of how this might help your business. If you haven't looked at it, if you think you should, It's commonly overlooked for a few reasons. There's probably a lack of knowledge of how fundamental it is to help your business, but also translating that Baroque tax language into your business is what Boast does. And we want to make sure you don't overlook this for reasons that could be overcome. So I'm going to provide a good education here for you and background, and hopefully give you some ideas of other ways you can help grow your business. A little bit about Boast. We are let me see here. Okay, we are a company based now in Canada and the US. So we operate in terms of helping businesses capture innovation tax credits in both countries. Both Ashley and I are focused on US-based businesses. Boast has been around since 2011, 1,000+ customers, 100+ employees and growing. We're venture-backed. We've processed $350 million in credits in the last couple of years. And what we're really doing is as I said earlier previously about the autopilot, we're building the software around helping businesses in SMB space to mid-market not only evaluate the tax credit, but also benefit from the data you can pull from that. And I think it's a really important part for strategic planning, for looking at your burn rate, for looking at growth strategies. It's really, I think, some compelling evidence we've uncovered and provided to some of our customers. So we're glad to talk to you more about that offline. We're going to talk to you now a little bit more just about how the tax credit actually works. So the key components here we'll cover for you today is, frankly, what is the R&D tax credit? Where did it come from? How does it apply? In what areas of your business, from a standard tax credit to a payroll tax credit? Definitely talk to you about the qualification criteria for that. Pardon me. Oops. Pardon me. Sorry. Let me get that back here. Pardon the interruption. Okay. And the 4-part test, and then also have a chance to go through a case study, give you an example of it, and then at the end have some Q&A for you. So the tax credit itself, this is a permanent tax law since 2015. It's the R&D tax credit. The spirit of the tax code, it started back in the 80s, was to help businesses grow in the US, grow your company, have employees here, do your product development here. And in order to benefit from that, they add some provisions. So in 2015, it became a permanent tax law where you could then not only for income tax liability, offset that with R&D tax credit, but also look at a payroll tax credit for businesses that aren't profitable, don't have a tax liability to corporate entity. So the idea is really, it's freeing up cash. It's a dollar-for-dollar discount from the QREs, the quality research expenses that we would identify for a business. And the idea is, if you are, funded early stage company, you can, take a look at that current year in the payroll tax credit and then start recouping some of those costs. So it's a really good advantage in order to, again, for hiring purposes and for being more efficient and frankly, managing your cash flow, because that's how you really want to look at it. The 4-part test, I'm going to turn over to Ashley here to walk you through how you qualify, and we'll go through the 4-part test by each section. So Ashley, I'll let you take it away from here.
Sure. So just as Tim said, we're familiar with the credit. So let's talk about how your company can actually qualify for it. When we're talking about the R&D credit and evaluating the activities and expenses for inclusion, the project that those activities and expenses are associated with has to meet what's called a 4-part test, which is what you see up on this slide. We're going to go through each one of these in more detail in subsequent slides here. So the first part of that 4-part test is that the project and the associated activities must be undertaken to develop a business component that is new or improved in regards to performance, functionality, quality, or reliability. You'll see 7 business components listed there in that second bullet, but commonly the most frequent ones we see is a product, so developing a tangible good for a customer, a process, so figuring out how are we going to develop this good or manufacture it, or the third one we commonly see is software. Something I do want to point out is that when we say software, we're talking about software that's developed for sell, lease, or license to a customer or a third-party interaction. There are times when we can look at what's called internal use software. So software you're developing to make your business operations more efficient. However, that software is held to a different level of scrutiny. There's some additional tests we have to meet. So it's a very case-by-case basis. So for today's conversation, we're going to be focusing on the more outward-facing software your company may be developing. The second part of that 4-part test is going to be an elimination of uncertainty. And what this means is that the activity must be intended to discover information to eliminate one of 3 uncertainties. So you don't have to have all 3, you only need one of these. The first one of those is going to be capability. So those are those instances where you're saying, okay, we agree this functionality for our software is needed, customers would love it, but can we actually develop this? Do we actually have the capability to meet those performance requirements we want to for this functionality? The second uncertainty is going to be methodology. So that's okay, we have the good we want to make, but how do we make it? What does that actual process look like for us to get to that final product? And the third is going to be design. Again, in the case of a software company, for example, you have a functionality you want to develop, but what does the actual design of that code look like to provide that functionality to your customers? I think something important to point out here is that whenever we're talking about uncertainties, we're talking about them in relation to your company. So just because there may be another company out there doing something similar, already have that functionality, what's important is that it's new to you and that you have that uncertainty. And going through, we're going to talk about here in the next slide of a process of experimentation to determine how to develop that functionality. So just as I mentioned, the third part of that 4-part test is that it requires there be a process of experimentation. I always tell people, go back to your junior high science class, because that's pretty much exactly what it means. And that this occurs when you engage in a systematic process to evaluate alternative solutions to overcome that uncertainty that we just talked through. And then you test those solutions and engage in that systematic trial and error process. So for example, writing code, testing the code, taking the results of that test, and going back and iteratively improving that initial code set until you get to code that you can move to a production environment. Then the fourth part of that 4-part test is technological in nature. So all of the activities that we're talking about occurring on those projects have to be rooted in a hard science for us to include those activities towards the credit. So it has to be rooted in the sciences of engineering, computer science, chemistry, biology, as opposed to soft sciences such as business management or psychology. So now that we know what it takes to qualify, let's talk about the actual expenses that we can include in the computation of a credit. When it comes to the credit itself, there are 3 different types of expenses that we can include. The first is going to be employee wages. And how we determine this is that we look at the amount of time that people are spending directly engaging in research. Think about this as maybe your computer or software developers, for example, directly supporting the research. So an example of this could be an admin, for example, sitting in on your development team meetings, taking notes and then handing those notes off to the development team, or perhaps somebody in a research lab who cleans beakers for the scientists to use in experiments the next day. And then we can also look at direct supervision. So this is going to be the time that your supervisors spend providing direct over-the-shoulder supervision of the development team, not necessarily directly engaging with them or helping answer questions, but purely just providing supervision of employees while performing qualified research activities. The second cost bucket that we can look at towards the credit is going to be supplies. So these are tangible goods that are consumed in the conduct of research. For example, a manufacturing company may need to buy material and components to build prototypes to physically test those prototypes to get to a final product. Another example of this is, Remember, just as Tim said, this was enacted in the early 80s, so pre-internet age. So the IRS did come back and include computer lease costs in here as a supply as well. So any cost you're incurring for cloud hosting from a Google Cloud Services or Amazon Web Services to host, test, or development environments, we can also look at those costs as well. And then the third cost we can look at including are called contract research costs. So this is working with an outside company to either do development on your behalf, such as hourly programmers to serve as overflow for development work, for example, or support your development, such as the case as testing services, for example, that you may need the results of those tests to then continue through that process of experimentation.
Awesome. Thanks so much, Ashley. So just one thing to add, it often would come up when we would talk to companies, when we're going through, the QREs, as Ashley just covered for you, the documentation, founders will tell me, oh, we haven't documented it, or we might use Jira, or they might not, or they use spreadsheets. So that's what we would do at Boast, is when we engage, and Ashley would be part of that, and we have technical expertise, and that's one of the key components is to we would help identify qualified projects, those QREs, go through the technical and financial reporting in order to develop that, because what we want to do is figure out, and this slide talks about, how does it apply. So there's also a financial component to that we're going to get more into in a little bit. But there's two ways that a business could benefit from the R&D tax credit. The first one would be a standard tax credit. So for some of our more mature companies, businesses that have been, outside the 5-year window, which we'll talk about for payroll tax credit, maybe Series B, Series C company, or company has profitability, 200 plus, sometimes technical employees, they're going to want to look at a standard tax credit. And this would be a credit that would offset any, in this case, you can look at a state and a federal tax credit. And this would be to reduce your income tax liability on an entity level. So whatever state you're in, your entity, you have a dispersed workforce, but it's always based on where your company is incorporated. And what is, I think, often misunderstood is these tax credits are carry forward. So there's multiple financial benefits for a larger company, but also you can carry it forward 20 years. So if you have a tax liability in the future, you're expecting a ramp in revenue and profitability, or if there's an acquisition coming up, there's a lot of ways to really get the benefit. And that's one of the things we make sure businesses that, could have a benefit, not necessarily even from a tax initially, but not lose out on the value for a future change in their business profile and their roadmap. The payroll tax credit, which we're going to talk mostly about here, again, this is also a carry forward. So all the criteria I covered a second ago on the qualified research expenses, the QREs, the 4-part test, same process, same criteria, same buckets of costs. The payroll tax credit, it's applicable for federal only. So if you're in California or Montana, or wherever the case might be, that is applicable for your US employees, all those costs for the payroll tax credit. And then for state tax credits, those are applicable if, again, kind of going back to the top for the standard tax credit. California is a particularly favorable state for a tax credit. So if a business, when we're going through the process and we've identified they are, remember, standard tax credit profile, would also look at a state tax credit, see there's some benefits there. Not all states do participate in the R&D tax credits. So how much can I recover? So the federal tax credit is a 10%. The bottom line, when you go through the QREs and come up with that top of funnel cost, you can expect 10% to come back to your business. So for every $100,000 you might be spending on a technical employee, 100% of their time, you do the math, you got $10,000 coming back. For the state tax credits, as I say, 7.5% would be the example of the California credit. Again, that would be for a business that's doing a standard tax credit. So when to claim? Ashley, you want to talk more about when to claim here?
Sure, absolutely. When it comes to the R&D credit, I do just want to reiterate something that Tim mentioned earlier in a previous slide, in that you can absolutely amend for the R&D benefit. However, you cannot amend for the credit and apply it towards your payroll taxes. So in order to use the credit to offset payroll taxes, it must be filed on a timely return, which is March 15th for pass-throughs and 4/15 for corporations, or a return on a valid extension, which is just a 6-month extension to each of those dates. We are already having conversations with clients for their 21 tax return, tax planning. So the sooner that you can start thinking about this, the sooner that you can monetize the benefit for your company. And so with that, I'll let Tim walk you through what it means to qualify for the payroll offset application of the R&D credit.
Awesome, thank you. And so yeah, a common theme is, a business will say, "Hey, I'm not profitable. How's this going to work?" Well, that's exactly that's actually a fair point and a key thing for qualifying for the payroll tax credit. There's some other factors as well. Number one, your technical team's based in the U.S. or 1099s, expenditures that are related to your product development. And then in terms of revenue, it's gross receipts. So the letter of the law is any form of gross receipts that is recorded, that starts the clock, let's say, of a 5-year window. You have no gross receipts, you're not profitable. You can look at the credit year over year. If you have a gross receipts in 2018 or 19, you got a 5-year window from that point on to then evaluate and do the credit. And the payroll tax credit, you can go year over year as long as you meet that criteria. Another factor is if you have 5 million in revenue in a given year, you would fall out of the qualifications for a payroll tax credit. And there's, for organizations that are obviously the 501s, not-for-profit organizations would not be able to claim a tax credit. Let me get into an example here for you on a payroll tax credit. And this is, when we do talk to companies, we are going to really kind of go from the very beginning, when you're incorporated, get an idea of where you are financially, your head count, your technical head count. Those are all important factors that we will help you weigh. If you're looking at 20% of your team or your spend, your OpEx is in that R&D space, you absolutely should look at it, even just to get a fundamental idea, like kind of Ed talked about earlier, kind of scoping, get an idea of how your business might look with TriNet. I recommend doing the same thing and looking at R&D tax credits. So you at least get a framework to go, even if this year might not make sense, then if you know your growth strategies going forward, then you can make an educated decision and a strategic one to then get the benefit and then also have that kind of planning into your financials. So in this example is the robotics company, a real example, but will be anonymous here. Incorporated in 2015, no income until 2017, which was through a round of funding. So in 2020, $2 million in revenue, not profitable, burning through cash, but hiring people and have a very large technical team. So you have 32 total employees, 20 being on the technical side, engineer, software development, just in that technical bucket. And then an average salary, $120,000 average salary for that technical team. So on a wage base, that technical team, they would meet the criteria for their salaries being completely dedicated towards R&D. So that would be an expense line of $2.4 million in wages as a QRE, top of the funnel QRE there. And then additional expenses like we talked about, the 1099s, cloud services, admin, and an example of 1099s or subject matter experts. If you are utilizing a university research institute here in the US and you're paying that institute to do testing for you, scientific, technical in nature, that also can be a cost category related to that area of 1099s. And that cost would be $130,000 of qualified research expenses. And so the total QREs in this example would fall into the maximum payroll tax credit of $2.5 million. So the qualified research expenses, going back to that previous slide, it'd come out to be $2.5 million. So it'd be a federal credit this company would leverage, which would be 10%. And then you have the credit, the maximum credit. And what happens is with the payroll tax credit is you would reconcile, we work with TriNet, the end of every quarter, you could reconcile your payroll tax credit, and you would go through that credit. If the payroll tax credits were going to exhaust your credit over 4 quarters, then you've used it all up. If it would carry forward, you can still carry it forward to the next year outside that 4 quarters, and then do your payroll evaluation the next year. So you can continue to build up that credit as well. So it's not, you remember, use it or lose it. The payroll tax credit does roll forward. And in this example, it was a very valuable, additional cash they had on hand to help extend their run rate, manage their financials well, and also to be able to hire faster. So that's just an example of one profile we've worked with, and we're glad to kind of walk you through. And this is the sort of analysis and breakdown we would want to discover with a company before we would formally recommend you engage and go through the whole process to get an idea of kind of where you might land in answering your questions on where you are financially and your hiring and where your employees are sitting. So Ashley, anything to add on this, or good?
I just had actually, if I could jump in, a question just in the Q&A, and asking about, with that prior example, what happens if your engineers are contractors versus salaried? How does that affect your qualifying expenditures?
Well, it would affect, and Ashley jump in, but so the 1099s have a limited percentage you can claim. You can claim 100% of their wages, as where the technical employee, if they are doing 75% of their time in R&D, that entire cost would qualify. Do you want to add anything to that, Ashley?
Yeah. When it comes to the evaluation of the contractor itself, we treat them just like an employee. Our main concern is looking at what are the actual activities that this contractor is performing for you, and where do they fall within that 4-part test we reviewed earlier. Now, where the difference comes in, however, is that the IRS came in and said, look, whenever you're working with an outside vendor to provide you with services, there's an inherent markup there. You're paying for their overhead, you're paying for some administrative fees. And so because of that, whenever we can take, whatever wage is associated with an employee for doing qualified research, when it comes to contractors, we have to scale that back a little bit and take about a 35% haircut on that, whatever qualified expense that we identify to help account for, those overhead charges that you're being charged for along with that. But outside of that, everything else is the same in evaluating those expenses.
Okay, so overall, contractors, typically you have to account for them less than 100%, approximately 65%.
Yep, exactly right.
All right, perfect. Another question that was earlier in the session, and just wondering about qualifying expenditures. Say the company is HQ in the US, but its operations are in another country. Where do those expenditures need to be for it to qualify for the program?
With that, I'd say keep in mind that this is a domestic credit. So whenever we're looking at the activities, whether that's your company or a contractor, for example, they do have to be based in the US. So if we're going to qualify them, that employee or that contractor or that company does have to be sitting here domestically.
Perfect.
And just one thing to add though, so I've seen situations where they do have majority offshore, some based in the US, and they would have a manager, COO typically, who's managing both teams. So keep in mind that C-suite, that person managing the overseas team, if they're based in the US, their time would be evaluated towards R&D because they are engaging, tracking the progress, maybe even doing technical solutions themselves. So that's something I always mention to the businesses when they do have offshore teams.
Yeah, fair enough. And just more the qualifying expenditures do need to be domestic, but the R&D could be overseas, I guess is what we're looking at. So trying to figure out what the actual domestic expenditures are.
Yeah.
Another question here just around, say your team is remote and you work in many different states. Does that impact how you claim?
From a federal perspective, it does not. From a federal perspective, doesn't really matter where employees are. From a state perspective, it does. in that, as Tim mentioned, there are a lot of states out there with very beneficial R&D tax credits available to companies. However, a stipulation of that is that the costs that are incurred or the employees have to be within that state. So for example, let's say we have a state where half of the employees are in California, half are in Utah. We can only take the half that are in California towards the California credit. Inverse that for the Utah credit, we can only take those half of the employees, but they would all count towards the federal credit for the company.
And do they have to file, would they have to file a tax return to take advantage of it in each one of those states where they were to take advantage of the state credit? Yeah.
Yep. And each state has different reporting requirements. For example, California mirrors very closely to the federal credit in their form, their computation of it. Whereas Utah, I don't believe it's changed within the last year, but it was, you just kind of have to include a one-line statement on your tax return, and they're like, that's good enough for credit. So, but you know, here at Boast, we're familiar with all of that, and they are always changing. So if you ever have questions down in the future, please reach out. We can absolutely talk those through with you.
Fantastic. Want to jump back over to Ed, and how does, you know, a PEO like TriNet work with the R&D tax credit?
Oh, thanks, Russ. And you know, this is just such an eye-opening conversation for me, because it gets really into the nitty-gritty, and I think it reinforces the value of having expertise. And you know, we count on partners like Boast. You know, I would much rather come to Ashley when a client asks us these type of questions for specifics, because I haven't memorized which states are going to more closely match the federal policy for R&D tax credits. I'm sure folks in the tax department have, but I really value our partnership, and this conversation today is, I think, really a good way to reinforce that. But to answer your question, Russ, when a client say comes to us and says, hey, we've spoken to Boast, we know exactly what we're going to look for in the R&D tax credit, TriNet is unique, I think, in our ability to capture those and apply those in pay periods or quarters going forward. So we really want to work closely with our clients to make sure that they can take advantage of those, and then they can apply those. And again, there are some specific rules, but I think a phone call with a partner at Boast, or a phone call with one of the consultants at TriNet, to really make sure that they're not leaving money on the table. Some of these programs are so lucrative, they're so advantageous, and I would be very curious with my fellow panelists. What we've heard is that fewer than 40% of the businesses that are eligible for these are actually taking advantage of the R&D tax credits. I don't know if that lines up with your figures, but that seems like a lot of small and mid-sized businesses are leaving a lot of tax credits on the table.
Yeah, we've heard similar stats just because of the complexity with it. And a lot of people don't understand it. And also with changing laws, I think Ashley had mentioned earlier, there was some new additions recently. Even the payroll tax offset was as new as 2015 being implemented. And for the first couple of years after 2015, nobody even knew about the program, which was, really beneficial to earlier stage companies. So there's still a big learning curve involved with it for people to take advantage of it, for sure. It was super helpful. Well, I'm just looking at the questions. There's no other questions. I had one other question just in terms of the benefit for the payroll tax. And how does that look like on receiving it? Is it's a cash check? Does the IRS actually send a cash refund? Like, how does that actually look from the benefit side?
I think you're asking me, so I'll go ahead and say it's not a cash check. In the R&D tax credit space, it's applicable, so it's applied against earnings. However, and Ashley and Tim, please bring me back in line if I overstep here, but in 2021, I believe the employee retention tax credit was in the form that it could actually be remuneration going back to the business, which, again, back to kind of like we just were speaking about, many businesses weren't even aware of the employee retention tax credit, which was an incredible amount of money that some businesses were eligible to receive. So For R&D tax credits, I don't believe a check was going back to the business. Tim, Ashley, keep me on the straight and narrow here, but I believe it's applied, to their overall tax liability.
Let's see, I can hop in here too, but yep,
Sure.
you're absolutely right. It will be applied on your 941 every quarter. And if you don't use the entire credit that quarter, it carries forward for 20 years to offset that employer portion of your payroll taxes that you're including.
Right. So what that means is by putting it on that form, you don't owe as much on your payables as opposed to getting the cash back. That is, so it's reducing your cash flow that you're owing, which leaves more money in your bank account, which is extending your runway, which we're tying back into the title. That's how we got there.
And Russ, if I could just chime in on that,
Yeah.
Just to kind of put it in really hard numbers, a life science client of TriNet, a small life science company that was doing well and had some funding, but still very small. I think they, had fewer than 20 employees. They did some research on catheter-based medical device that when they applied for the R&D tax credit, it was just over $150,000 US that was applied to their future tax liability. So these are real dollars. That was a significant amount of money for them.
Yeah, absolutely. Well, yeah, I don't see any other questions in the Q&A. So with that, I think we'll wrap things up from here. You can always get a hold of the Boast team. Just go to Boast.AI. We've got a ton of content on there. We've got a bunch of traction webinars as well. I think there's over 200 episodes on there with topics ranging from scaling sales, marketing, product, HR, and whatnot. And you could also reach out if you're looking to get more information on the PEO side and TriNet. What's the best way to reach you guys, Ed?
If I thank you very much, Russ. It's my email is just ed.coady, so ed.coady at trinet.com. And we do have a verticalized team here. So if it's a life science company or a tech company or let's say professional services, I'll make sure to route that to the consultant in that particular geography or that industry. So it's ed.coady at trinet.com.
Perfect. Appreciate that. Well, thank you, everybody. Very informative, very insightful today. Let me check. There might be one last question coming in. Yes, there will be a recording that will be sent around on this. So, and any other questions, you could definitely reach out to us at Boast.AI. Thanks very much, everybody. Ashley, Tim, Ed, really appreciate your time today and your insights, and we'll see you next time.